Should young investors use leverage? Conventional wisdom says absolutely not. It's risky and can wipe out your portfolio. But what if the standard advice is too conservative and actually holds back long-term returns for those just starting out? Today we'll dig into the academic research, practical tools, and risks so that you can make a truly informed decision. Today's video is sponsored by WisdomTree, one of the leading ETF providers globally. So why should we leverage early? If you're early in your career, your total wealth is mostly future earnings, what economists call human capital. The money actually in your investment account today is tiny by comparison. And usually experts suggest that young people stay far away from leverage. Just invest your available money in stocks and wait. But Ayers and Nailbuff in their life cycle investing studies ask, what if you could invest based on your total future wealth, not just what's in your bank account today? A traditional approach to investing produces this shark fin-shaped investment pot over our lifetimes. We gradually build up our savings and then draw down on them when we retire. But notice the concentration risk around the retirement point. That's the dashed yellow line. The idea behind temporal diversification is to use leverage early on, and that builds up the investment pot rapidly, particularly the equity holdings. With leverage, you can more quickly get close to your true optimal lifetime stock allocation, and that could boost your lifetime returns and also smooth market risk over many decades. Now let's turn to the evidence from research. Ayers and Nailbuff rigorously tested these ideas. Their research found that a simple 2-to-1 leverage approach using borrowed funds or derivatives to double your stock market exposure could be helpful. Ayers and Nailbuff's 250 strategy uses leverage early on in a career to keep about half of lifetime wealth in equities. In the first phase, young workers borrow to invest up to 200% of their savings in stocks. As savings accumulate, the second phase gradually reduces leverage while maintaining the 50% lifetime target. By retirement in the third phase, no borrowing is needed. The portfolio naturally settles into a balanced 50-50 mix. The big win was that risk is spread more evenly over your life. By leveraging when young and gradually reducing that exposure, you avoid concentrating risk into a few years and reduce volatility by about 20% compared to a standard constant allocation approach, like sticking to a single life strategy fund throughout the course of your life. Ayers and Nailbuff simulated 96 cohorts of workers, each with a 44-year career, ranging from 1871 all the way up to 2009. These three graphs compare wealth at retirement for three different strategies. The constant mix approach invests a fixed 74% in stocks, while the leverage 250 strategy starts at 200% and then tapers to 50%. Now both of those deliver the same average retirement wealth, that's the red dot that you can see, but the leveraged approach achieves it with roughly 21% less volatility. And the glide path strategy, which is the bottom panel, achieves lower mean and median wealth than the other two strategies. The key is that leverage early on spreads equity exposure more evenly across a lifetime, and that reduces the extreme highs and cushions the lows. These conclusions held up whether Ayers and Nailbuff tested US, UK, or Japanese markets, or whether they simulated returns with Monte Carlo analysis. And they found that margin calls, where your broker forces you to sell, are very rare in 2-to-1 strategies, and that's if you stick to sensible risk controls. So how can leverage be implemented in practice? Well, Ayers and Nailbuff highlighted that the cost of borrowing is crucial for a leveraged investment strategy to be effective. Low costs make leverage attractive, while high costs undermine it. They discussed two forms of leverage. The first one is buying on margin, which is a loan from your broker, and the second one was a form of derivative called leaps. These are long-term call options. Their research found that the implied interest cost for 2-to-1 leverage can be quite low, sometimes close to 1% when they publish their paper, which is during a period of low interest rates. But they also noticed that this rate of borrowing increased sharply for higher leverage, with 3-to-1 leverage costing much more. They stressed that the relevant rate is the margin rate, which reduces the effective equity premium and also the optimal stock allocation when it's high. If you can earn a fairly high rate of interest with a risk-free investment, it simply makes stocks less attractive. Now, competitive rates are sometimes available via low-cost brokers or via derivatives, but these depend on market conditions and also the product structure. The key takeaway is that leverage is only beneficial when the expected return on stocks comfortably exceeds the cost of borrowing, and that makes careful attention to the funding costs absolutely essential. The cost of leverage will vary depending on the risk-free rate of interest. A good proxy for that is your central bank's policy rate plus a risk premium. In the UK, for example, the rate to watch would be bank rate, which you can find on the Bank of England's website. You can see it here. As I make this video, it's 4%. But if we try to gauge that risk premium for lending to retail investors, we could take a look at interactive brokers. The rate, assuming a £10,000 balance, would be about 5.5% at the moment, and that's about 1.5 percentage points higher than the bank rate, which we just saw. Now, derivatives will probably embed a lower borrowing rate, and that's because the institutional investors, like investment banks, that create the options can borrow more cheaply in the markets than we can as retail investors. Also, it's probably worth noting that we're currently in a falling interest rate environment, and that could make this strategy, which is leverage, potentially more attractive. For UK investors, margin loans, derivatives and LEAPs aren't allowed inside ISAs or SIPs, but you can still get leverage through daily leveraged exchange traded products, or ETPs. WisdomTree, for example, offers 2 times and 3 times equity ETPs that give you clean, transparent access to leverage inside a tax-advantaged wrapper. And in this table, you can see some of those exchange-traded products offering 2 times and 3 times daily leverage. All of these are denominated in sterling. Just remember, leveraged ETPs magnify market movements and can lead to a total loss of your investment. Ensure you understand the risks before investing. More information about WisdomTree's leveraged products and the applicable risks can be found in the link below. The key thing to understand is that these ETPs reset daily. That means that over longer periods, especially in volatile markets, your returns may drift away from exactly 2 times or 3 times the index, a phenomenon called volatility decay or compounding. WisdomTree's leveraged ETPs have a recommended holding period of 1 day. They're designed for short-term tactical use, not long-term buy and hold without monitoring. That said, you can combine them with lower risk assets like gilts or money market funds to dial down your effective leverage. For instance, allocating 2 parts in the 3 times S&P 500 ETP to 1 part in a money market fund would approximate a 2 times S&P 500 ETP exposure. But it would also give you the flexibility to increase or reduce the leverage to suit your risk tolerance. It's a practical way to bring the leveraged lifecycle idea into a UK portfolio. Just remember, the daily reset and volatility effects mean you need to keep an eye on it. So let's just summarize the advantages and risks of this leveraged approach. Well, firstly, you can do this inside an ISA or a SIP. These products are available inside those wrappers, and you won't have to pay capital gains tax or income tax on those investments. Secondly, you can fine-tune your exposure by combining these products, the levered products, with safer investments like money market funds, gilts, or even cash. And thirdly, you've got the flexibility that you can adjust your exposure over the course of your life or according to market conditions, but also depending on whether you've reached your investment target. The first drawback is that you've got volatility decay. Let's say markets are just trending sideways, and if there's a lot of volatility, then you can lose money because of the daily reset on the individual products. Secondly, I think complexity is a problem. These strategies are more difficult to understand than simply buying an index and holding it for a long period of time. Thirdly, these are strategies which you have to monitor. These aren't set and forget strategies like it would be if you bought an index fund, say. And fourthly, you have to consider funding cost. If the risk-free rate really starts to rise again, which it may do in the future, then these strategies become less attractive because of the inbuilt cost of leverage. Now, if you are uncomfortable with leverage, there are some alternatives. The first one to consider would be simply saving more. Now, that might not be easy because you have to budget carefully, you have to scrimp and save, but that may be more in line with your psychology. Leverage comes with a lot of volatility, and that's not comfortable for everyone. The second approach is just to stick with the idea of life cycle investing. It may not do as well as these levered approaches, but it works for most people most of the time. You start off with lots of equity and then dial that down just before retirement, just after retirement, or even sooner. A third approach, which is also very interesting, is to look at dynamic asset allocation strategies. These respond to market conditions, but also look at the approach to your financial goals. And in fact, some of these strategies offer really good risk-return characteristics, which has been published in more recent research than Ayers and Nailbuff. For example, one dynamic allocation strategy from the paper which is shown in the source on this slide was found to offer a better median and mean return than the leveraged approaches that we've just seen. In this strategy, you have a target amount that you estimate would give you sufficient funds on which to retire, so that's always at the back of your mind, that's your target. And then you start with 100% equity allocation, 100% stocks for the first 20 years of your investments. At the end of that 20-year period, if you've achieved your target, the assets are switched into a safer portfolio comprising 80% stocks and 20% fixed income bonds. Otherwise, you remain invested in 100% stocks if you haven't reached your target. And this process is carried out for the next 10 years. In the final 10 years, the assets are switched to a portfolio of 60% stocks and 40% fixed income if you've achieved your target. Otherwise, you remain invested in 100% stocks. So in conclusion then, should young investors use leverage? I think the theory is really compelling, especially if you want to diversify risk across your entire lifetime. When borrowing costs are low and you've got the discipline to stick to a strategy despite market falls, and remember those could be very severe if you have leverage, a modest amount of leverage early on in your investing journey can pay off. But beware of the pitfalls. Borrowing rates, product quirks, emotional barriers, and regulatory restrictions mean that you must be realistic and thoughtful about this approach. Leverage can bring real benefits, but only for those who understand the risks and who are willing to monitor their portfolios and use these tools with care. For most people, a slightly higher savings rate or a dynamic allocation approach is probably safer. But if this did help clarify the debate for you, hit like, subscribe, and let me know your thoughts in the comments below. And, as always, thank you for listening.